That last paycheck has hit your bank account. It's a strange feeling, isn't it? After decades of work, of saving, of planning, it all comes down to this single number on a screen. For the first time, you're in complete control of your entire retirement fund. A lifetime of wealth is sitting right there. And with that total freedom comes an almost paralyzing sense of risk. Most people think the biggest danger in retirement is running out of money. They're wrong. The real danger, the one that separates a wealthy retirement from a worrying one, is way more subtle. It's a hidden threat that can cripple your portfolio in the first few years, even if your long-term returns end up being fantastic. Before you make a single move, before you buy that boat, book that trip, or even pay your first month's bills, you need to understand this one principle. Because ignoring it is like trying to navigate a minefield blindfolded. For your entire working life, the game was simple: pile it up. You put money into your 401k, your IRA, your brokerage accounts. You focused on growth, on getting the highest average annual return you could. The financial world told you to think in terms of averages. An 8% or 10% average return over 30 years would get you to the finish line. But the moment you retire, the rules of the game change completely. Averages become almost meaningless. The new game is about distribution, and in this game, the order in which you get your returns matters more than anything else. This is a concept called sequence of returns risk, and it is the single most destructive force for new retirees. Imagine two people, both retire with $1 million, and both average a 7% annual return over their first 10 years of retirement. One ends up wealthier than when they started, the other is on track to run out of money. How is that possible? It's simple: one retired into a strong market, and the other retired just before a downturn. When you're withdrawing money to live on, selling your assets in a down market permanently locks in those losses. It forces you to sell more shares to get the same amount of cash, which leaves you with fewer shares to benefit from the eventual market recovery. Getting hit with poor returns in the first few years of retirement can be catastrophic. It's a mathematical hole you can never dig out of, no matter how well the market does later. This isn't a theory, it's a brutal reality that has blindsided countless retirees who thought they did everything right. The one principle that will protect you from this isn't some hot stock tip or a complex financial product. It's a fundamental shift in how you structure your money. It's about moving away from thinking of your nest egg as one big pile of cash and, instead, building a financial fortress with 3 distinct layers of defense. This is what will let you sleep at night, knowing your income is secure, your capital is preserved, and you're still set up for the growth you'll need for the next 30 years. Section 1, The Great Unwinding. Your final paycheck has landed. The moment that last paycheck arrives, the great unwinding begins. You are shifting from a net saver to a net spender. This mental shift is huge, and it's where the first critical mistakes are often made. Faced with a lump sum that represents their life's work, many new retirees fall into one of two traps: panicked action or paralyzed inaction. The panicked retiree immediately starts making moves. They see a scary economic forecast, like the recent historic downward revision of 911,000 jobs, and sell all their stocks, fleeing to the perceived safety of cash. Or they get a tip from a neighbor about some can't-miss investment and plow a huge chunk of their savings into it. These are emotional decisions, driven by fear and greed, the two worst financial advisors you could ever have. The paralyzed retiree, on the other hand, does nothing. Overwhelmed by the sheer number of choices, annuities, bonds, stocks, withdrawal strategies, they just leave their money where it is, often in the exact same allocation they had during their working years. While this feels safer, it can be just as dangerous. A portfolio built for accumulation is rarely suited for distribution. It's likely too aggressive, exposing them to the full force of that sequence of returns risk we just talked about. The real villain here is volatility, specifically volatility in the first 5 years of retirement. Research shows these first 60 months are the danger zone. A big market downturn during this period, when you're starting to make regular withdrawals, can have a massive and devastating impact on how long your portfolio lasts. Let's make this real with a stark example. Consider two retirees, both starting with $1 million and needing to withdraw $40,000, adjusted for inflation, each year. Retiree A experiences a bear market right away. In her first 2 years, the market drops 15% each year. To get her $40,000, she's forced to sell assets at these rock-bottom prices. By the time the market recovers and delivers strong positive returns, her portfolio is so depleted from those early withdrawals that it never fully catches up. She ends up having to drastically cut her spending later in life. Retiree B, however, enjoys a bull market in his first 2 years. His portfolio grows, and his $40,000 withdrawals are just a small dip from a much larger bucket. When the market eventually has the same downturn that Retiree A faced, Retiree B's portfolio is so much larger that it can easily withstand the shock. He sails through retirement with confidence. Both retirees had the same average returns over the long haul. The only difference was the sequence. This is why the first thing you must do with your money is not to find the next winning stock, but to build a structure that insulates you from this exact risk. You need a system that lets you pay your bills without being forced to sell your growth assets at the worst possible time. Section 2, The One Principle, Building Your Financial Fortress. The one principle that separates a wealthy retirement from a worrying one is this: you must segment your money based on when you will need it, ****. Instead of seeing your savings as one giant pot, you'll divide it into 3 distinct buckets, each with a specific job, time horizon, and risk profile. Think of it as building a financial fortress. You need a moat for immediate defense, a strong keep for stable supplies, and watchtowers to spot and capture opportunities for future growth. This is often called the bucket strategy, and it's the most effective way to diffuse sequence of returns risk. Bucket 1, the liquidity moat, 1 to 3 years of living expenses. This is your first line of defense. Its only job is to provide for your immediate income needs, no matter what the stock or bond markets are doing. This bucket should hold 1 to 3 years worth of your essential living expenses in cash or cash-like investments that are safe, stable, and easy to access. This is non-negotiable. This mode is what lets you sever the link between your daily spending and market chaos. When the market plunges 20%, you won't feel that knot in your stomach because you know your mortgage, groceries, and bills are covered for the next few years by this bucket. You will not be forced to sell your stocks while they're on sale. What goes in here? High-yield savings accounts * completely liquid, FDIC insured, and as of April 2026, many are offering rates around 4%. Money market funds * these are mutual funds that invest in very short-term, high-quality debt. They're highly liquid and aim to keep a stable value, with many funds in April 2026 yielding around 3.5% or higher. Certificates of deposit, CDs ***. You can build a CD ladder. For example, if you need $120,000 for 3 years of expenses, you could put $40,000 into a 1-year CD, $40,000 into a 2-year CD, and $40,000 into a 3-year CD. As each one matures, you have cash ready. With top 1-year CD rates in April 2026 hovering around 4.8%, this strategy provides safety with a decent return. The cardinal sin of retirement is being forced to sell growth assets to pay for a carton of milk. This bucket prevents that. It is your buffer. It is your peace of mind. Bucket 2, the stability core, 3 to 10 years of future income. This is the strong keep of your fortress. Its main job is to generate stable, predictable income and preserve your capital with just a little bit of growth. This bucket is designed to refill your liquidity moat, bucket 1, over time and holds the money you expect to need in the next 3 to 10 years. The allocation here is heavily skewed toward bonds. For a retiree in their late 60s, this bucket, combined with the cash in bucket 1, would make up the fixed income part of their portfolio, maybe around 35 to 50% of their total assets. What goes in this bucket? Intermediate-term bonds * bonds with maturities between 3 and 10 years offer better yields than short-term bonds without the high interest rate risk of long-term ones. Think U.S. Treasury notes, high-quality corporate bonds, and municipal bonds. Bond funds and ETFs * a diversified bond fund is the easy button for spreading risk across hundreds of different bonds. Treasury inflation-protected securities, TIPS. The principal value of these bonds adjusts with inflation, giving you a direct hedge against rising costs. Dividend-paying, low-volatility stocks ***. A small slice of this bucket can go to stable, blue-chip companies with a long history of paying dividends, like utilities or consumer staples. Annuities ***. For some people, a portion of this bucket could go to a fixed-income annuity, which can provide a guaranteed stream of income. The goal here isn't to hit home runs. It's to hit consistent singles and doubles. The income, interest and dividends, from Bucket 2 is used to systematically refill Bucket 1 as you spend it down. So, if you spend $60,000 from Bucket 1 this year, the interest payments from Bucket 2 are moved over to replenish it. Bucket 3, the growth engine, long-term growth. This is the part of your portfolio that ensures you don't outlive your money. This is your engine for long-term growth, designed to outpace inflation for the rest of your life. Don't forget, a 3% inflation rate will cut your money's purchasing power in half in just 24 years. Without a growth engine, even a huge nest egg will be slowly eaten away. This bucket holds the money you won't need for at least 10 years. This bucket is invested almost entirely in stocks, equities. That might sound wrong for a retiree, but it is absolutely essential. Recommended stock allocations for retirees often range from 20% to 60%, depending on age. For someone in their 60s, a 50 to 60% stock allocation is common. What goes in this bucket? Diversified stock index funds / ETFs * low-cost funds that track the S&P 500 should be the core of this bucket. They give you broad market exposure and diversification. International stock funds * don't keep all your eggs in one country. A globally diversified portfolio can capture growth from around the world and reduce risk. Growth stocks * a smaller slice can be dedicated to individual companies or sectors with high growth potential, but know the risks. The beauty of the three-bucket system is that it lets you be a calm, rational, long-term investor with your growth stocks. When the market has a terrible year, you don't even look at this bucket. You're living off Bucket 1. When the market has a great year, you can skim some profits from Bucket 3 to refill Bucket 2. This disciplined process is the key. Create the illustration using this image and this text. Use an illustration only without including the text. Section 3, The Mechanics of a Worry-Free Retirement. Okay, having three buckets is the principle. Now, how do you actually make it work? It's a simple, elegant system of withdrawals, refills, and rebalancing. The withdrawal and refill strategy. The money always flows one way, from higher risk to lower risk. You live off Bucket 1. You refill Bucket 1 from Bucket 2. You refill Bucket 2 from Bucket 3. Year-to-year living, you pay all your bills from your cash in Bucket 1. Annual moat refill ***. At the end of each year, you see what Bucket 2 generated in interest and dividends. Let's say you spent $50,000 from Bucket 1, and Bucket 2 produced $35,000 in income. You move that $35,000 over. Now you only have a $15,000 shortfall in Bucket 1. Strategic rebalancing ***. Now you look at Bucket 3. How did the stock market do? If the market had a strong year ** perfect. You sell enough of your appreciated stocks from Bucket 3 to cover that $15,000 shortfall in Bucket 1 and maybe even top off Bucket 2. This is called rebalancing, and it forces you to do the one thing every investor dreams of, sell high. If the market had a flat or down year ** you do nothing. You don't touch Bucket 3. You leave your growth assets alone to recover. Since you still have plenty of cash in Bucket 1, you aren't under any pressure to sell. You just wait for a better year. This is how you preserve your capital and defeat sequence risk. The role of tax efficiency. You have to be smart about where you hold these buckets to minimize your tax bill. Tax-deferred accounts, traditional IRA/401(k), these are best for holding assets that generate lots of taxable income, like corporate bonds. The tax deferral shelters that income. Just remember, all withdrawals are taxed as ordinary income. Tax-free accounts, Roth IRA/401(k), ***, this is the holy grail for your growth assets, bucket 3. All future growth and withdrawals are completely tax-free. You want your fastest growing assets here to maximize that benefit. Taxable brokerage accounts ***, these are flexible. They're a good home for long-term stocks you don't plan to sell often, since you'll get lower long-term capital gains tax rates. They are also a great place for your cash in bucket 1 for easy access. When it's time to withdraw, a common strategy is to pull from taxable accounts first, then tax-deferred, and leave the tax-free Roth accounts for last. Also, you must be aware of required minimum distributions, RMDs. Thanks to the Secure 2.0 Act, you generally must start taking them in the year you turn 73 if you were born between 1951 and 1959, or in the year you turn 75 if you were born in 1960 or later. These mandatory withdrawals from your traditional IRAs and 401(k)s need to be part of your plan. This framework is a powerful start, but your situation is unique. Your expenses, risk tolerance, and family needs will shape your fortress. If you're finding this helpful, subscribe for more deep dives into retirement topics. And let me know in the comments, what's your biggest worry as you get close to retirement? Section 4, the pitfalls, the 3 horsemen of retirement ruin. Even with a great plan, it's easy to get led astray. You have to be able to recognize the enemies at the gate. Let's call them the 3 horsemen of retirement ruin. 1. The siren of over-conservatism. This is the retiree so terrified of a market crash they put everything in cash and CDs. They've built an impenetrable moat but forgot the fortress. They've solved for sequence risk but completely ignored inflation risk. They feel safe watching their account balance stay stable, but under the surface, their purchasing power is silently being eaten away. A portfolio earning 2% while inflation runs at 3% is losing real value every single year. Over 30 years, this is a guaranteed path to getting poorer slowly. You must have a growth engine. 2. The ghost of market timing. This retiree is the opposite of the first. They think they can outsmart the market. They watch the news, see a scary headline, and sell everything. Then, once things feel safe again, after the market has already bounced back, they buy back in. They are consistently selling low and buying high, the exact opposite of a winning strategy. They abandon the bucket system's discipline for the adrenaline rush of making a call. Nobody can consistently time the market. The bucket strategy is designed so you don't have to. Trust the system, not the headlines. 3. The mirage of the one-size-fits-all solution. This is the danger of grabbing a generic rule of thumb and running with it. You hear about the 4% rule or the 60-40 portfolio and assume it's the perfect answer. But these are starting points, not finish lines. Recent research from firms like Morningstar suggests that for someone retiring today, a safe withdrawal rate is probably closer to 3.9%, and even that comes with risks. Your personal rule might be 3.5% or 4.5%, depending on your health, retirement age, and portfolio. A one-size-fits-all approach is almost always a one-size-fits-none solution. Your plan has to be tailored to you, which is where a good fiduciary financial advisor can be invaluable. The journey into retirement isn't an end, it's the start of a new and critical phase of managing your money. The skills that got you here, working hard, saving diligently, focusing on accumulation, are not the same skills that will carry you through the next 3 decades. The central idea you need to embrace is the shift from a single pot of money to a structured, 3-bucket fortress, a liquidity moat to secure your present, a stability core to provide reliable income, and a growth engine to secure your future. This structure is your shield against the single greatest threat to your financial security, the destructive power of sequence of returns risk. It gives you a disciplined, logical framework that takes emotion out of the equation, letting you sell high in good times and protecting you from selling low in bad ones. This isn't about finding a magic bullet. It's about building a resilient system. It's about recognizing that in retirement, preserving your capital and the reliability of your income are just as important as growth. By doing this with your money before you make any other move, you aren't just investing, you're engineering a financial future that's built to last. And that gives you the one thing money is actually supposed to buy, the freedom to stop worrying about it.